Malaysian markets rally while the ringgit hits a 10-month high after the governing National Front coalition extends its 56-year rule, seeing off a strong challenge by an opposition alliance that had unnerved investors. And things have been picking up recently for American exporters. But Europe is still a big worry. We go to New Orleans to visit one company that has a winning recipe. Hello and welcome to World Business Report. I'm Juliette Foster. In a minute, we'll have a look at some of the day's other top business stories. But first, let's start with Malaysia, where it has been an exciting morning for the financial markets. Both the stock market and the currency, the ringgit, soared. That was after election results kept the governing National Front coalition in power. Stocks added more than 7% to their value as worries over political instability fizzled out. Well, Shireen Mahiyuddin is the managing director and principal fund manager at Corsten Asset Management. She now joins me from Malaysia's capital, Kuala Lumpur. Shireen, a very good day to you. It's a very positive market reaction, but why were investors so keen for a National Front victory?
No, I don't think that they were keen for a National Front victory per se, but they wanted the election overhang to be over. And now that it's over, you can actually see that the risk overhang for the markets has gone. So this is why the rally has happened. The Malaysian market has been underperforming the other markets for so long, and it's not as if there's anything wrong with the economy. It was just because of the election overhang.
But has that overhang really disappeared? Because the Front didn't get a resounding majority, and some would argue that that makes the Prime Minister rather vulnerable, and markets hate uncertainty.
Now, I think that the markets are pleased that it isn't a hung parliament, which is what some people were expecting. And he has got a majority, although not a two-thirds majority, which we feel is something of the past. I think that the voter turnout at such a high percentage was very positive for Malaysia. As you know, we focus on corporate governance in our investment style. So having this kind of voter turnout was very positive for us.
OK, well, the government does have its work cut out for them. So looking at the economic plans lying ahead, what is it going to do about Malaysia's debt levels?
For the debt side, Malaysia is going to have to do some of the necessary changes, such as, the previous subsidies that we have in place and widen the tax collection scheme. That's going to have to happen, and in most nations, ahead of an election, you don't implement these type of policies. So we will probably see some of those more unpopular policies coming through.
OK, there's also concerns about domestic investment. It tends to be linked to government companies, and some businesses feel that that doesn't really create a level playing field. So presumably, that's something else that they're going to have to change in business culture. Yes, I think that from our point of view, what we'd like to see is more governance in all business transactions, more transparency. But as the markets continue to mature, and we've been running money here for 25 years, we are seeing maturity and changes taking place, although some people would argue too slowly. But it is happening. Okay, Shireen Mahiyuddin, we're going to leave it there, but thank you so much for joining us with your analysis there of that election result. Thank you so much. Now, US exporters benefited as countries around the world rebounded from the lows of the financial crisis-induced recession. But with Europe still struggling and with other currencies weakening against the dollar, American companies may find life just that little bit harder. Michelle Fleury now reports from New Orleans, where she found one company that has found the ingredients for export success.
This is ground mustard seed that we procure from Canada.
At Magic Seasonings, they take their spices very seriously. Their blends are sold around the world, but their flavour could only come from this part of America. This exporter got its start here in New Orleans, in the kitchen of Chef Paul Prudhomme.
They would just say, what are you putting in the food? And so we'd just give them some, and it would just be a little package with a little foil on it, and then they'd come back and say, I want to buy some, and it just, now it's all over the world.
Outside the U.S., our first market was Japan. It started in 1985. have distribution in 37 countries, and our biggest market today is next door is Mexico, followed by the UK, and then in turn comes Japan as a third market.
Make a little smoke, do a little dance.
Today, Magic Seasoning is one of the companies contributing to America's exporting strength, and it's helping President Obama get one step closer to his goal of doubling US exports to the world by the start of 2015. And America is already halfway there. Back in 2009, the US exported $1.5 trillion worth of goods and services around the world. In 2012, that climbed to a record $2.1 trillion, well on its way to President Obama's goal of $3.1 trillion by the start of 2015.
We reach 1 billion consumers around the world from this river right here.
Roaring demand from developing countries has benefited companies in this part of the world, especially those who make higher-end products.
Typically a niche product, one that is high value, highly processed in some manner, branded, packaged here in the United States, is sold at a higher cost overseas. In China, for example, American foods are in huge demand to the perception of quality and safety. And so, to be honest, a lot of times the high-end consumers don't care what it costs. In fact, they want it because it's expensive.
To boost American exports, President Obama has thrown his support behind trade deals with Europe and Asia Pacific. At a time when the US is struggling to recover, it's a strategy that may ensure these waterways stay busy. Michelle Fleury, BBC News in New Orleans.
Now, later today, we'll get the latest economic outlook for Italy from the country's National Statistics Service. Following the appointment of the new Prime Minister Enrico Letta and the relative stabilisation of the country, it's thought the outlook will have a somewhat positive tone to it. But what now for Italy? Has the third largest economy in the Eurozone finally turned a corner? Can austerity measures be eased off? Well, joining me now in the studio is Christian Schulz. He's the senior economist at Berenberg Bank. A very good day to you. Before we look at those questions, what do you expect from this survey? Is there anything to feel positive about?
Well, we'll probably see another slight improvement in the sentiment in Italy, in the economic sentiment. We've had some improvement at the beginning of the year, then we had the election and all the uncertainty surrounding that. Things deteriorated again, and now that we have a government, we expect the sentiment to improve again, but we remain in recession, so we're coming from a very low level, and it's only a slightly less bad recession.
Right, OK then, so not bad news, but don't get excited just yet, which is fair enough given what lies ahead for the Prime Minister. I mean, the main struggle for them is to keep their budget deficit target under the EU's target of 3%. Can they hold that, or do you think they're likely to overshoot it?
Well, they are probably likely to overshoot. I mean, we have a tradition in Europe now of forecasts being overshot. That's likely to happen in Italy as well. The recession is continuing. But how much of an
overshoot here?
Well, that's the difference. We used to have overshoots of 1% or 2%, and now we're getting overshoots of a few tenths of a percent. So it's not something drastically worrying. We have to keep in mind that the bond markets are much more benign for these countries now. Borrowing costs are at euro crisis lows at least. So that also shows that the markets are trusting countries more that they can get through this crisis. But I think the key remains that the European Central Bank has put in this safety net last July, which has led to the overall improvement in market sentiment towards the Eurozone, which helps Italy.
Right, so that works in Italy's favour. But at the same time, the Deputy Economy Minister, Stefano Fassi, he says Italy needs another 2 years if it's going to hit its targets, its budget deficit target. He says, look, it's been given to Spain, it's been given to Portugal and Greece. Why can't we have it? Is the Eurozone likely to concede on that point?
I think we've had a shift really in this crisis strategy this year. We've so far always had this, you have to hit the target, the deficit target. If you don't hit it, you have to cut more. Now countries are more looking at the economic situation and the budget in conjunction. So if a country misses the target because it's in a deeper than expected recession, that's fine. And that's what happened in Spain, in Portugal, now in France as well, and probably in Italy as well. And if a country is not in recession anymore, then they they have to cut maybe even more. So they're hitting more the structural deficit and not the nominal ones anymore. And I think that's a positive change here.
Right, OK, but it's a subject we'd like to be returning to in the weeks to come. But Christian Schulz will leave it there as time runs against us. So thank you so much for joining us. Let's move on now and take a look at some of the day's other business news, starting with China, where growth in the services sector slowed down sharply in April, coming into its lowest point since August 2011, providing fresh evidence that economic revival will remain modest and may be facing wider risks. The HSBC Services Purchasing Managers Index, otherwise known as the PMI, fell to 51.1 in April from 54.3 in March, with new order expansion the slowest in 20 months. Staffing levels in the service sector decreased for the first time since January 2009. OK, there'll be more business updates later, but in the meantime, that's it for the moment. Thank you for joining us.